A company worth $32 billion ran its books on QuickBooks, the same software a corner bakery uses to track invoices. For most of 2022, FTX was the good crypto company, the clean one. Its founder testified before Congress, gave to charity, promised to give away his entire fortune. Regulators trusted him. Venture capitalists lined up to hand him money without a board seat. He was the adult in a reckless room. He was stealing from his customers the entire time. Roughly $8 billion in customer money vanished into a second company he secretly controlled. In the next few minutes, you'll see how the fraud was built into the code itself, where the money went, and why the man brought in to clean it up said he'd never seen anything like it in 40 years. And that includes Enron. Start with the marketing, because that's what the public saw. FTX spent tens of millions putting its name everywhere. It bought the naming rights to the Miami Heat's arena. It signed Tom Brady, Steph Curry, Larry David. In February 2022, it ran a Super Bowl ad. Larry David playing a man who doubts every great invention in history, from the wheel to democracy. The spot cost roughly $6.5 million. The joke was that doubting FTX made you a fool. That ad ran for 30 seconds in front of 100 million people. 9 months later, the company was bankrupt. The people who trusted it lost everything. Then look at how the company was actually run. FTX had no dedicated accounting department. A firm handling billions in daily transactions kept its financial records the way a freelancer keeps a mileage log. There was no complete list of who worked there. Expenses were approved by employees sending emoji reactions in a chat. Corporate money and personal money moved back and forth with no line between them. This wasn't a company that got sloppy. It was never a real company, because underneath FTX sat a second business, and that's where the money actually went. Alameda Research was a trading firm. On paper, it was separate from FTX. In reality, it was run by the same small circle, and it was losing money on bad bets, so FTX simply fed it customer deposits. When you sent dollars to FTX to buy crypto, that money didn't sit in your account. It flowed to Alameda, which spent it. By the end, the gap was somewhere around $8 billion. Real money from real customers gone, and they never knew it had left. Here's the part that turns carelessness into a crime. The theft was written into the software. Every FTX customer was supposed to be governed by an automatic risk system. If your account went too negative, the engine sold your position to protect everyone else. Alameda had a secret exemption. A single flag in the code: allow negative, let it run a balance no other account could. Its credit line, according to trial testimony, had a capacity of around $65 billion. Gary Wang, who wrote much of that code, testified to it. Caroline Ellison, who ran Alameda, testified to it. This wasn't a loophole someone found. It was a door someone built on purpose and hid. And with that door open, they spent. Some of the money bought real estate in the Bahamas. Around $256 million in property, luxury homes, and a penthouse where Bankman-Fried and his inner circle lived, a unit reportedly worth $30 million. On the customer expense spreadsheet that tracked all this, one witness described a category that spoke for itself. Nishad Singh, one of the top executives, testified that the spreadsheet included a line for buying an island. Not as a joke, as a budget item. That same executive described where the political money came from. FTX gave heavily to campaigns and causes on both sides of the aisle, tens of millions of dollars. But the donations were routed to appear as though they came from FTX executives personally. The money disguised so no one would trace it back to the source. Customer funds laundered into political influence, wearing someone else's name. They understood exactly how this looked, which is why they tried to leave no trace. Messages at FTX were set to delete themselves. Ellison testified that Bankman-Fried instructed staff to use Signal with disappearing message settings turned on. She said he cited a policy, a principle he'd articulated, against creating records that could be used against you later. A company that kept no proper books also made sure its conversations erased themselves. That's the tell. Bad businesses fail. They don't shred the evidence on the way down. Then the whole thing came apart in 19 days. In early November 2022, a report questioned Alameda's finances. Customers rushed to pull their money out. But the money wasn't there. It had been spent. The withdrawals froze. On November 11th, FTX filed for bankruptcy. A $32 billion empire was worth nothing by the end of the month. The man brought in to sort through the wreckage was John Ray. He had overseen the cleanup of Enron. In his first filing to the court, he wrote a sentence that has followed this case ever since. Never in his career, he said, never in 40 years, had he seen such a complete failure of corporate controls. The man who cleaned up Enron thought this was worse. Strip away the arena naming rights, the Super Bowl ad, the congressional testimony, the promises to give it all away. And what's left is simple. A company took its customers' money, spent it on real estate, political favors, and bad bets, and hid the theft inside its own software. On March 28, 2024, Sam Bankman-Fried was sentenced to 25 years in prison and ordered to forfeit around $11 billion. He'll be in his 50s when he gets out, but the sentence doesn't undo it. The people who lost money weren't hedge funds. They were ordinary savers who'd been told this was the safe, honest exchange, the one that ran a Super Bowl ad mocking anyone who doubted it. They doubted, and the ad told them they were fools. They believed instead, and believing is what cost them everything. There's a strange epilogue. As crypto prices recovered, the FTX estate began paying customers back, and many are getting all of it, some more than 100% of what they lost. In June 2026, Bankman-Fried lost his final appeal. The sentence stands. The savers improbably are nearly whole again. He is not a $32 billion company run on QuickBooks, and yeah, that's real.